Welcome to The Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to The Weekly Option. This is episode 362 on February the 14th, 2025. I'm your host, Eric, and in this week's show, we're going to cover the trades from last week on Aurora Cannabis, New Holdings, and Lyft Inc. And we discussed three new trades on Lucid Group, ARK ETF, Innovation Trust ETF, and AMC Entertainment Holdings. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for The Weekly Option. Now, the stock market finished the week at all-time highs once again. I haven't been able to say that in a while. The Dow Jones Industrial Average gained 242 points, closing at 44,546 points. The S&P 500 index gained 88 points, ending the week at 6,114 points. And now it's time for the topic of the week. The topic of the week is creativity. Typically, when we use the word creativity, we think of art or music or some other structure that allows more of a freedom of expression of oneself. Well, I'm here to tell you that you could be creative with options as well. There are times when you may not be able to execute a trade the way that you would like to, or you might want to lock in a profit on a trade with very little liquidity. One scenario is when you are long a call spread and the market is going higher. Your spread is deep in the money, but you can't seem to sell it for its real or true intrinsic value due to there being less liquidity in the market. Now, you want to lock in a profit, but you're going to have to find a way to protect against the downside risk, right? If the market goes the other way, you're going to lose money on that spread that's in the money. So you can't seem to sell it for its real intrinsic value due to less liquidity in the market, but you still want to lock in that profit. So you're going to have to find a way to protect against the downside. Rather than sell the spread outright, you might be able to buy a put option that will increase in value even more than the value of the spread if the market heads the other way. In this scenario, if the stock price stays high, you make money on your call spread that you own. If the stock market falls, the put option you bought might make more money than the spread itself. Now, at this point, it just becomes a game of math, which I always talk about on the show. Now, these sorts of scenarios tend to come up when we're approaching expiration, and I wish it only happened every now and then, but this is a common situation. The ability to be creative with options tends to be directly proportional to how well you understand options. In layman's terms, the better you understand how to trade options, the more you'll be able to see creative strategies to either lock in a profit or minimize risk. It's a new year already, and we are almost halfway through Q1. Now, I'm going to be starting up a training class soon. So if you're interested in learning more about options trading and taking your knowledge beyond theory and definitely into practice, send me an email. We'll have a phone call and I'll get to know a little bit more about you, which is always fun. And we'll see if any of the coaching options make sense for you specifically. So that's it for the topic of the week and that little introduction to coaching for the year. Let's go ahead and get into the trade review of last week's trades. We're going to start off with our covered call on Aurora Cannabis. Symbol A as in Alpha, C as in Charlie, B as in Bravo. At the time the stock was trading for $6.03 per share, I looked at buying stock and selling the February 6.5 call at 27 cents, hoping for a return of 12.27% in 2 weeks. Well, shares of Aurora Cannabis gained 28 cents, ending the week at $6.31 per share. The call option that we sold finished the week unchanged, leaving us with a net gain of 28 cents if we were to close the trade out immediately. Now, of course, it's strange that the call option didn't finish the week with a different value at all. The time value of the last 5 days would have lowered the price of the option some. The 20-cent gain in the stock would have made the call option increase in value, so that means that the increase in the stock value was directly offset by the time value that would have been removed from the stock over the last 5 days. Either way, the The trade is working out in our favor, is working out as planned, so no adjustments are needed. We're only 1 week away from expiration, so you'll definitely want to keep track of the stock price over the coming days, but so far, so good. Next up, we have the credit spread on new holdings, symbol N as in November, U as in uniform. At the time, the stock was trading for $13.74 per share. I looked at selling the February 13 put spread at 15 cents. That could give us a maximum possible loss of 35 cents per spread. Well, shares of new holdings lost 5 cents, ending the week at $13.69 per share. The out-of-the-money put spread that we sold is still out of the money. The stock price is still above the break-even price, which means we're still in the profit territory on this trade. So with 5 days left until expiration, everything is looking good. No adjustments are needed on this trade so far, but you definitely want to stay abreast of the stock price. And then our final trade from last week is going to be the debit spread on Lyft Inc., symbol L as in Lima, Y as in Yankee, F as in Foxtrot, T as in Tango. At the time, the stock was trading for $14.17 per share. I looked at buying the February 14 call spread for 32 cents. That could give us a maximum gain of 18 cents, or that's a return of 56.25% in 2 weeks. Well, shares of Lyft fell 74 cents, ending the week at $13.43 per share. That in the money call spread that we bought is now out of the money. The share price is 39 cents below the break-even point, and at this point, we're definitely on course to lose our maximum amount of money, which is 32 cents from this spread. Now, we could make an adjustment, but most of the ones we would make might lead to a larger loss. Now, we could collect 23 cents for selling the 14 call spread. That would leave us with a short 14 call spread. We would then turn around and sell the 12 put spread at 7 cents to create the iron condor. That would also create a maximum profit range in the stock of $13 to $14. Now, we would collect 30 cents on selling these two spreads, which just about gives us all of the money that we paid to enter the spread, just minus 2 cents. However, we'd still be on the hook to lose another 50 cents if either spread finished in the money. Therefore, this adjustment would actually increase the amount of risk on the table, right? At this point, I would rather not make an adjustment and see if the stock heads higher in the next couple days. Another way to limit risk is to just simply close the trade early and walk away with a bit of a loss. Either way, I'll have a couple decisions to make in the coming days, but I'm pointing this out because it's always important for you guys to walk through individually all of the possible adjustments that you could make. Sometimes an adjustment might look like the right idea, but in reality, it's going to increase the risk on the trade. Because remember, when you buy a spread, the most you could lose is the amount of money that you paid for the spread. So you want to make sure that you understand how these spreads work and how much money you could actually lose and how much money you could actually gain as well if you were to have a win. So sometimes it's just not worth it. All right, so that's it for the review of last week's trades. We went through all three of them. We are 1 week away from options expiration for monthly options in the month of February. Expiration will be on Friday, February 21st. I should also remind anyone that trades in the U.S. markets that the market will be closed on Monday, February 17th in observance of President's Day. Now, all new trades on today's show will use the March 21st expiration for monthly options in March. So let's go ahead and get this going. We're going to start off with the covered call on Lucid Group, symbol L as in Lima, C as in Charlie, I as in India, and D as in Delta. The stock ended the week at $3.31 per share. I'm looking at buying stock and selling the March 3/2 call at 35 cents, hoping for a return of 16.31% in 5 weeks. Then you enter this trade by buying stock for $3.31 and selling the March 3/2 call at 35 cents. This trade makes the most money if stock prices finish above $3.50 per share. The break-even price in this trade is $2.96 per share. And in real terms, the stock purchase will require $331, and you'll collect $35 for selling the option. Next up, we have the credit spread on ARK, or I think it's ARK, Innovation Trust ETF, symbol A as in Alpha, R as in Romeo, K as in kilo, K as in kilo. The stock ended the week at $67.01 per share. I'm looking at selling the March 66.65 put spread at 35 cents. That could give us a maximum possible loss of 65 cents per spread. Now you enter this trade by selling the March 66 put at $2.29 and concurrently buying the March 65 put for $1.94. This is a credit spread because we're selling the spread, and this trade makes the most money if stock prices expire above $66 per share. The break-even price on this trade is $65.65 per share. In real terms, you'll receive $35 per spread that you sell, and you'll still have $65 at risk for each spread. And our final trade for the week is going to be a debit spread on AMC Entertainment Holdings, symbol A as in Alpha, M as in Mike, C as in Charlie. The stock ended the week at $3.56 per share. I'm looking at buying the March 3.5 call spread for 32 cents. That could give us a maximum gain of 18 cents, or that would be a return of 56.25% in 5 weeks. Now you enter this trade by buying the March 3 call for 73 cents and concurrently selling the March 3 half call at 41 cents. This is a debit spread because we're buying the spread, and this trade makes the most money if stock prices expire above $3.50 per share. The break-even price is $3.32 per share. In real terms, you'll pay $32 to enter this spread, and your maximum gain is $18 per spread. So that's it for this week's show. Thank you guys so much for listening. I'm going to dive right back in. It is Valentine's Day here in the U.S. and presumably around the world, so I should get back to focusing on my Valentines. I hope you guys have an amazing weekend, and as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.